Taysha Gene Therapies, ticker TSHA, just completely missed Wall Street consensus across the board for their Q2 2026 earnings print. I mean, we are looking at an EPS of negative 13 cents, which missed the negative 11-cent consensus by a full 2 cents, and top-line revenue, absolute zero. A massive goose egg, completely missing estimates of roughly $693,600.
Right, and management guided that their cash runway is now extended into the second half of 2028. But, that runway is heavily bolstered by a recent equity raise, not operational success.
Yeah, and the stock immediately punished the miss. After closing the regular session up at $6.68, shares just reversed in after-hours trading, dropping 6.44% to $6.25. And the bleeding really continued over the next 2 days, gaping down to open at $6.13.
Exactly. It ultimately drifted down to 595s on really thin volume as all those technical moving averages just broke down.
So with that headline miss and the market reaction established, we need to transition into dissecting the segment performance. Because this wider net loss, the zero revenue reality is a stark contrast to the $1.99 million in Q2 2025.
It is. But you have to remember, this is structurally due to Astellas Pharma. Basically, they returned the full unencumbered rights to TSHA 102 in late 2025. So that stripped Taysha of any recurring collaboration revenue.
Oh, wow. So they are entirely on their own now.
Yeah, completely independent. And if you walk through the operating expenses, they ballooned to $50.7 million.
Which is huge. R&D expenses alone skyrocketed 92% year over year to $38.6 million.
Right, and that was driven by clinical costs for the REVEAL and ASPIRE trials, which were actually over-enrolled. Plus, they had those intensified process performance qualification, or PPQ, manufacturing campaigns.
Right, scaling up that manufacturing is brutally expensive. And then G&A expenses rose, 40.7% year over year to $12.1 million.
Yeah, directly tied to compensation and their pre-commercial launch readiness initiatives. They're gearing up for a launch.
Wait, they had an $81.3 million first half operating cash outflow, but their balance sheet actually looks okay.
Well, yeah, it was reinforced by that June 2026 underwritten public offering. They priced 32.5 million shares at $6, plus pre-funded warrants, which grossed $230 million.
So that pushed their cash and cash equivalents to $455.4 million.
Exactly.
Looking at this income statement, it looks less like a standard biotech earnings miss and more like an intentional massive capital expenditure phase. It's essentially burning the ships to fund a solo commercial launch.
I like that. Burning the ships. And this extreme cash burn and transition to being an independent commercial developer naturally leads into, what management's commentary actually revealed about their clinical progress.
Right, to justify all this spend. So CEO Sean Nolan and R&D head Sukumar Nagendran highlighted the completion of dosing in both major trials.
Yeah, the REVEAL pivotal trial with 17 adults and the pediatric ASPIRE safety study with 4 patients ages 2 to 4.
Which is a solid milestone. But then they laid out this wildly aggressive forward timeline. They expect a 6-month interim analysis of the REVEAL trial in the first half of 2027.
And they intend to use that interim data as the basis for a biologics license application, a BLA, which could potentially accelerate the U.S. commercial launch by 2 full quarters.
Wait, instead of waiting for the standard 12-month data, filing a BLA based on a 6-month interim analysis of just 17 patients is incredibly aggressive. Are they risking massive regulatory friction at the FDA by attempting to bypass a standard 12-month data package?
It's a huge gamble, absolutely. But they are pushing ahead. PPQ manufacturing at Catalent's Harmon's Maryland facility is on track to finish in Q4 2026.
Okay, so the manufacturing side is moving.
Yeah, and the FDA has already accepted their analytical comparability approach between clinical and commercial lots, which is a massive de-risking event.
Wow, okay. And management also noted that commercial readiness is about 80% complete. Their payer research showed really strong support for TSHA 102.
Because of the convenience, right? It's a one-time outpatient intrathecal administration.
Exactly. But the payers also emphasized that durable functional gains will be the primary driver of reimbursement. They want to see it actually last.
Naturally. And this aggressive timeline and all the friction it might cause forms the exact crux of the current Wall Street debate surrounding Taysha's valuation right now.
Let's talk about that Wall Street consensus because it's fascinating. Despite the stock sell-off, sell-side analysts maintained unanimous buy or outperform ratings.
Unanimous. Canaccord is at $17, Baird at $15, BMO at $14, Goldman Sachs at $13. The median target is $12.77.
Which is over 100% upside from that post-earnings $5.99 floor. So what exactly is the bull case here?
It's heavily driven by the REVEAL part. A longer-term cohort. We're talking about 12 patients with 12-plus months of follow-up who showed a 100% responder rate.
A 100% responder rate. That just smashes the FDA line 33% historical control threshold.
It completely destroys it. Patients achieved 310 functional gains and 31 discrete developmental milestones without hitting a clinical plateau.
That is incredible efficacy. But we have to look at the bear case and the notable risks here, starting with evaluation.
Right, because Taysha is trading at a price-to-book ratio of 9.8x, which is massive compared to the biotech average of like 2.5x to 5.3x.
With a 9.8x price-to-book ratio, the equity is priced for perfection. Doesn't that mean even a minor manufacturing delay at Catalent or a single additional neurological toxicity event in the Aspire cohort could absolutely crater the stock?
Yes, the margin for error is literally zero. And on the safety front, a grade 2 peripheral sensory neuropathy serious adverse event, an SAE, did occur in July 2026.
I saw that, but the patient rapidly recovered and the protocol didn't even change, right?
True, but it highlights the inherent neurological toxicity risks of A89 vectors. It's a known class risk that always spooks the market.
And then you have the execution risk. They are heavily reliant on a single-arm, open-label trial design.
Which the FDA scrutinizes intensely because there's no placebo control to separate the drug's effect from bias.
Right. And timing-wise, there's a catalyst gap in the second half of 2026.
Meaning the stock will just trade entirely on macro trends and technicals until those 1H 2027 data readouts.
And it has to trade through a massive wall of dilution. The outstanding share base has ballooned to over 325 million shares following that June offering, creating heavy technical overhead.
Exactly. Any rally is going to face heavy selling pressure from institutions locking in quick gains.
So for you listening, it leaves a pretty provocative thought about the broader implications for retail investors holding clinical stage biotech equity.
Yeah, you have a company with a highly de-risked transgene construct, but it's operating with a highly vulnerable, open-label, single-arm trial design.
Exactly. The critical question to monitor isn't just the efficacy. We know it works. The question is whether the FDA's recent flexibility on rare disease endpoints will actually hold up if any further AAV9 vector toxicities emerge before the 2027 readout.
That's the real test for this stock moving forward.
Make sure to follow the show for your daily earnings coverage.